PFR Nation, this is Kevin Lau, your host of the Planning for Retirement podcast, and welcome to another episode. This is officially episode number 63. Retirees, should you give yourself a raise? So I totally botched last week. I said it was 63 last week on our budgeting and cash flow episode, but that was 62. I think I was just getting all antsy and excited for going weekly. So this is episode 63, the official episode 63. And if you've been following along the Whiteboard Fireside Chats on YouTube, you've seen me record several episodes from my dining room table. I am doing the same thing today. I'm actually working from home today. Yesterday, I came home from work. I was feeling a little bit, feeling some flu-like symptoms. Many of you know my wife, and also all three of my boys got the flu this month. And so I was working from home quite a bit this entire month. It's been a little exhausting, but I was kind of bragging over the last couple of weeks that I didn't get the flu yet. So yesterday, I had some flu-like symptoms yesterday. I had some chills, some body ache. I didn't even take my temperature. I just ended up going to sleep at 6:30. I was feeling like crap. But woke up this morning not feeling terrible. So we'll see what happens today. I don't know if it's because I was super amped to record this episode. Who knows? But today's going to be a great episode. I'm super excited to dive into this topic. We're also going to be sort of weaving in and out of some other topics related to rates of withdrawal, the 4% rule, guardrails, and ultimately how that kind of dovetails into this idea of giving yourself a raise. And there was an episode I recorded a couple of years ago. It was this notion of retirees underspending in their go-go years. And this is a similar sort of framework in terms of this episode is like, from my experience, it's very difficult when retirees enter that early phase of retirement of drawing down their portfolio, okay? Especially if we go through volatile times in the market. Think about the 2022. If you retired in 2022, and let's say you had a nice little 60-40 portfolio, you figured, hey, I've got a little bit of equities, but I also have some downside protection, the 40% in fixed income. Well, listen, there was nowhere to run in 2022. Most likely, if you're in a traditional 60-40 portfolio, your portfolio was down probably 12, 13, 14%. So on $1 million portfolio, you're talking about now your portfolio is worth 850, 860, 870, and you're drawing income from the portfolio potentially to bridge the gap for over Social Security or over a pension that you might have. So I did a survey on the YouTube channel. Speaking of YouTube, I did a survey on the YouTube channel, and overwhelmingly, you all wanted to hear about estate planning, the softer side of estate planning. So I think we're going to tee that up for next week. So I'm excited about that one. But last week, I just mentioned, we did the cash flow budgeting episode number 62. I hope you guys found it helpful. And really this framework of establishing your budget and establishing your cash flow needs, both before retirement and ultimately in retirement, is going to create this framework of like, hey, how much do you need to withdraw from your portfolio? And then once you have that rate of withdrawal plan, then the question comes like, hey, how do you give yourself raises during retirement? So we're going to talk about some of these popular frameworks, the 4% rule, this framework of guardrails, okay? And so this is going to be a good one. So I'm excited about it. Before we jump in to the topic today, there are a couple big news stories I wanted to get into, okay? And I've got my little outline, this little old school outline here, because I am recording this from my dining room table. So we've got the paper outline, the printout. Normally I've got the dual monitors in the office. So I've got the little paper outline. So I'm going to do a little paper popping like my boy Josh Pate in his podcast. If you guys are college football fans, Josh Pate, check out his podcast. It's phenomenal. But anyways, so I talked about this on episode 60, 5 things the markets are looking for or watching in 2025. And that was a big one. That was actually this. I think that's the number one downloaded episode that we've released in about a year. I think there was maybe one more that has more downloads, but I think you know what it was? Episode number 50, the 50 truths retirees wish they knew before firing their boss. But this is right there, number 2. So I think a lot of you are really interested in like, what is the market doing? What's going on with the markets? Is this tech bubble ready to burst like in the early 2000s? Okay. Well, a big part of the headline this past week. Okay. So this episode's coming out on Tuesday. Okay. So this would be, I don't know, like February 2nd, maybe, or 3rd. And I'm recording this on Thursday, the 30th. And this week, there was a really interesting story that broke, okay, around DeepSeek. All right. So now you know about DeepSeek. Okay. It's been about a week now since the story's been out. But ultimately what happened was there was this massive shock or fear in the markets that the amount of spending, the billions of dollars of money that's being poured into this AI initiative, AI investment, the Trump administration announcing their investment into AI. There's billions of dollars being poured in to big tech and other tech companies to develop and train AI models. And all of a sudden, we've got this little Chinese startup company. Okay. I think they were founded on, like, I don't know, 2020 or 2021, I want to say, maybe a little bit before then. But it's backed by this hedge fund, which more on that here in just a second. But ultimately what happened was they released their own AI model. So, like, think of it as like their version of Chat GPT. And if you don't know what Chat GPT is, just like go to openai.com and learn more about that. Chat GPT is kind of been that gold standard of like user-friendly AI technology. Ask it anything. It's going to spit out a bunch of information, basically information that they curate on the internet. And this little Chinese tech startup, DeepSeek, they came in and they said, hey, look at our AI model. And I think they released theirs a couple of weeks ago, this new one that's really kind of made the shockwaves in the headlines. And it turns out it's better than ChatGPT, or if not better, it's equal to ChatGPT. And here, this startup, all in, their cost to build this thing was $6 million. And so it kind of sent some shockwaves into the tech industry. And there was a massive sell-off in the big tech markets. Particularly one of the names is NVIDIA. NVIDIA, has been a darling of the stock market over the last couple of years. I think it was like 200 something percent in 2023, 170 something percent in 2024. And I actually had a client reach out to me a couple of weeks ago. He said, and if you're listening to this, I don't mean to call you out. It's just, I'm not going to say your name, but I don't mean to call you out. We hear this type of stuff all the time. But I had this client reach out a couple of weeks ago. He works in big tech. Okay, he works for one of the Magnificent Seven companies. And he said, hey, Kevin, I kind of want to take a position on my portfolio, and I want to go really heavy on NVIDIA. And the hype is real. I want to go aggressive on NVIDIA. And I just told him, I said, listen, looking at your portfolio now, with our investments, we do use predominantly ETFs, exchange traded funds, which have these big tickers in there, the big tech in there. It just has NVIDIA and et cetera, et cetera. So I told him, I said, listen, Mr. Klein, I said, we have roughly 3.5% of your portfolio in NVIDIA already. You may not see that particular name show up in your portfolio, but given the exposure that the ETFs we use have in your portfolio, we already have 3 to 3.5%. I think this is pretty healthy already. Don't think it makes sense for us to go super aggressive on NVIDIA, especially after the last couple of years. And price to earnings on NVIDIA, it's a little bit concerning on that one. I think don't quote me on the multiple here, but I think it's somewhere trading in like the 60 range of price per earnings. And the historical average on an S&P 500 company, a PE ratio, has been more in the 20 to 25 range. So kind of a lot of people would say overvalued, but listen, if this AI hype is real, their chips are necessary to go in and train these AI models. And so that's been the big initiative, this big pull in from NVIDIA is, hey, develop and build these chips. And it's going to go out to all these other tech companies that are building these AI models. And here DeepSeek comes in and it's like, hey, we don't need your expensive chips. We've got your cheap chips that somehow, I don't know how they got their hands on these, frankly, because that's one of those things. Like, there's been blocking on these chips going into China just because of national security issues. But what happened was Monday going into the markets, there was a massive sell-off in big tech. I think the tech index, the NASDAQ, I think was down close to 3% that day. But NVIDIA and a lot of these other big tech names got sold off big time. NVIDIA, namely, they were down about 17% in one day on Monday. And so I emailed my client this. I wasn't trying to like toot my own horn because I did talk him off the ledge on this one. I said, listen, you have the exposure in there already. We don't need to go overboard and just go like crazy FOMO with NVIDIA. And he responded. He's like, I appreciate it. He's like, I saw this news. He's like, I immediately thought of you, and I just appreciate you making me stick to the plan, because his game plan is perfect. He's got a perfect game plan to achieve work optional very, very young, okay, very early, relatively speaking, probably in his mid 50s. And so anyways, I just thought I'd bring that DeepSeek story up because a lot of you have probably heard the news around this one, and you might be concerned about this. And this is exactly why we've been going in. This is what we've been spending time on in the end of December into January, is reviewing our model portfolios, looking at the performance in each asset class in our portfolios and saying, hey, let me take some of the winners off the table, big tech, let me trim those, and let me reinvest in some other asset classes that we believe are more attractive from a valuation standpoint. And this is exactly why we want to be doing this, because any kind of news like this, I'm not saying this DeepSeek thing is going to totally revolutionize AI. I think there's a lot of sketchy things going on with the company being backed by a hedge fund, a Chinese hedge fund. That's super shady, right? Because hedge funds, they make a ton of money when the markets go down. They short investments. So kind of my thing is like, hey, are they doing this just to basically cause these big tech names to plummet and they profit on this? I don't know. I'm just speculating here. But ultimately, hedge funds, that's how they make money. And DeepSeek is backed by the hedge fund that the founder started. So anyways, there's a lot of shady business going on with that. And this is exactly why, in my opinion, that Trump is being so harsh on China, is because they just can't be trusted. They want to take down America. They want to take down the US. All right. And so the point being is that any bad news, any potential scares in the big tech market, because their assets, all of these stocks are what we call, quote unquote, priced to perfection. This is why you want to be cautious with this one. You don't want to go crazy overboard with big tech. Yes, it's been the darling leader in the S&P 500, frankly, since 2009. Okay, so we've had a nice little run with big tech, but you don't want to go overboard. You want to have a disciplined, unemotional, repeatable process. Okay, what we call DURP, D-U-R-P. So the next story I wanted to talk about, this is actually really fun because I can talk about some relevant news stories. Given we're going weekly, I don't need to just rush into a topic. Like, hey, I can hit on some of these news stories that I'm talking about with my clients directly. Clients reach out all the time with questions that they might have about the news or about the markets, et cetera. But this one, I thought I wanted to bring this up to you because this has been the big news story over the last couple of days, is this deferred resignation program or this DRP, basically this federal buyout. And this is interesting. Okay. I read a little bit about this the other day, didn't have a ton of time to go super deep into it, but it seems to me like the DOGE, the Department of Government Efficiency that is run by Elon Musk, it seems like this is really, it's kind of going, it's diving in head first, in terms of like trying to make waves, trying to impact the federal government, trying to change the way federal government is run. And ultimately their goal is to make the federal government leaner, more efficient, and more productive. Okay. Which I think we're all for overall. But ultimately what happened was every federal worker, at least to my knowledge, every federal worker received an email from, I don't think it was from the DOGE. I can't remember exactly who sent out this email, but it was a little weird. It was an email that was sent out to every federal employee announcing that they have a decision to resign by February 6th. And if they decide to resign before or by February 6th, they will continue to receive pay, I believe, through the month of September. So basically 8 months. If they don't decide to resign by February 6th and take this deferred resignation program, then they're going to be forced back into the office 5 days a week. So that's a big deal. I think I can't really say that this shocked me because at the end of the day, Trump ran on this idea of DOGE straight off the bat. That was part of his campaign promise, was like, hey, I'm going to drain the swamp back in 2016. I'm going to cut down government inefficiency, which, listen, I worked for a big bureaucracy for the first 12 years of my career, 2 big bureaucracies. And I kind of get that. You know what I mean? There's a lot of fat that you could potentially trim to make it leaner. And ultimately that, in my opinion, that makes things more productive. When there are fewer layers in terms of getting things done, in my opinion, there's more efficiency. There's less duplication of work, duplication of communication, and more efficiency. So I think it doesn't surprise me, but it is a little wild, this mandate of going back to 5 days a week. Actually, my sister-in-law, she works for the federal government. And so it's kind of brutal because, on one hand, I think a lot of us agree that there is probably a lot of fat to be trimmed. But then on the other hand, it's like, there are some really darn good federal employee workers that are working from home that can do just as fine of a job at home than they can in the office. And so I definitely have sympathy for those individuals. But I grew up in the DC area. So I have a lot of friends and family members that are either work for the federal government, have close ties to the federal government. Maybe they're contractors doing the federal government's job, whatever it might be. So I have a lot of sympathy for those individuals that are impacted by this. Okay. But I think the point of me bringing this up is that you've got to have an exit strategy at all times. Like, you can't just assume, hey, I'm 55 now. I'm going to work until 65. So I've got 10 years of runway. You can't just assume that, because things come up like this all the time. I had this client I'm thinking about a couple of years ago moved down from New York down to Florida. And his assumption was, hey, I'm going to kind of work remotely. We're good during the pandemic, during the pandemic migration. I'm going to just live in Florida, work for Microsoft. We're good over here. They're allowing me to do this. But then all of a sudden, I think it was 2023, maybe it was early 2024, they had this return to office mandate. Okay. So this is not new. It's not like the federal government's making this up. And I guess my warning to you all, but my plea to all of you is like, hey, obviously you have a date in mind where you're like, hey, I probably would like to work until this age. And I enjoy what I do. I can work until 65 or 70 if they'll have me. But if not, what is the earliest age I can become work optional? I think that's kind of what I'm trying to get at here is, when can you become work optional? And how do you set your plan up to achieve that? And if you're continuing to work past that date, good. It's kind of gravy on top. It's like you're going to pad your portfolio, or maybe you could back down your savings rate and spend more money on experiences today because you've achieved that work optional, or gift more to your family members, or charity, whatever you might do, or maybe scale back your risk, the risk in your portfolio, because you're like, hey, I won the game. I don't need to be super aggressive. Maybe I do dial it back to a balanced portfolio to take some of the volatility off the plate. There are a lot of options out there that work in your favor if you have this work optional mindset of retirement. Like, don't assume retirement is like, hey, I'm going to just work until this date because that's when Social Security is going to start for me, or that's when Medicare is going to start for me. You just never know, whether you're working for the federal government or another corporation, when they're going to initiate these types of cuts. Okay, because this isn't new. I mean, one of my buddies reminded me about the Bill Clinton administration back in the mid 90s. They did the same thing. His initiative was trimming the fat. I mean, he didn't say drain the swamp, but ultimately that's what he did in the mid 90s. They cut their workforce by hundreds of thousands of workers, making things more efficient, tightening things up. And listen, to my knowledge, the Clinton administration is probably the only administration that actually reduced the federal deficit. Okay, so can Trump achieve that from 2025 through his term? To be determined. We shall see. But I think right now there are a lot of people that are up in arms about this, and rightfully so. I think about my sister-in-law. I mean, she is not super close to the office anymore, and she is a great worker. Yeah, in my opinion, she's a great worker, super hard worker. It's a little tougher. Her family situation, her kids' activities, family member. It's just a dicey situation just to ask someone, hey, you need to now either come into the office or move back close to an office. It's just not everyone can achieve that. And we'll see. I think there are a lot of legal ramifications coming down the pipeline here with regards to, is this actually going to hold up? I think there are a lot of people, a lot of experts out there saying like, hey, don't accept this deferred resignation program yet. Kind of wait and see. But I guess, again, my point is, don't just assume because you intend to work until a certain date that that's ultimately going to be how long you work. Have a plan, create your work optional strategy, create that exit strategy. Build up your retirement nest egg, build up that emergency fund, like I talked about in the last week's whiteboard fireside chat. Build up that emergency fund. So even if you're not fully retiring, you've got a 3, 6, 9-month window where you can go ahead and find something different, find something new before you jump back into the workforce or ultimately fully retire. All right, let's jump into today's topic here. All right, so I guess before we jump into this idea of should you give yourself a raise and all these different frameworks of retirement income withdrawals, let me just kind of backtrack and talk a little about the 4% rule, okay? Because we've got a lot of new listeners on the show. And let me just give you all a refresher on the 4% rule. So the 4% rule was really made famous by Bill Bengen. So Bill Bengen was a former rocket scientist who turned into a financial planner later in his life, because when he retired, he tried to find a financial planner that was income focused, not wealth accumulation focused, like someone who understood the back end, how you make withdrawals from the portfolio, what is a safe withdrawal rate. And he couldn't find anyone, nor could he find any research out there that sort of pointed to what a safe withdrawal rate was. So he essentially, what he did is he back tested using a sample portfolio of the S&P 500, 50% there, and 50% in 10-year US Treasury. So it's a very simple portfolio. You got to use some example in terms of back testing, but he back tested way back into the 20s to figure out, hey, was there any period of time where a certain percentage rate of withdrawal sustained 30 years and never failed? Okay, well, like, was there any 30-year period that a certain percentage of rate of withdrawal did not succeed? So he started at 8%, 7%, 6.5%, 6, 5.5%, 5, 4.5%, 4%, even 3%. So we tested all of those starting rates of withdrawal. So like, as an example, if you were starting with a 4% rate of withdrawal, if you went with that rule of thumb and you had $1 million portfolio, your first rate of withdrawal, the first year you retire, is going to be $40,000. And every single year you adjust your rate of withdrawal by whatever the inflation rate is. So if inflation is 3%, or let's say 2.9%, like in 2024, then you would give yourself a 2.9% raise on your rate of withdrawal. So that would be $1,160 on top of the $40,000. So in the next year, you would withdraw $41,160, and you just rinse and repeat for as long as you live. Okay, so there's not a lot of flexibility. There's not a lot of thought in terms of like the timing of the go years versus the slow go years versus the no go years, which is what we like to talk about with our clients. But it's fine. It's a framework. Okay, and this is why I use it as a benchmark, not kind of the be all end all. But this 4% rule was revolutionary because what Bill found was that starting with the 4% rate of withdrawal, there was never a 30-year period where you fell short. I think the worst case scenario was someone who retired in 1966. So someone who retired in 1966, kind of rewind the tape a little bit, went through two major bear markets and recessions in the first handful of years of retirement, which is a no-no. We talk about kind of that early bear market in terms of impacting your rate of withdrawal. A lot of times it's that first 2 years. If you hit a bear market, it's a little tight. Okay, things can get a little dicey for you. So no one has a crystal ball on this one. That's why you have to have a solid plan if you run into that type of scenario. But someone who retired in 1966 had two of those in the first handful of years. But even then, at least from my notes, their portfolio still lasted about 33 years. And so the thing about the 4% rule, though, there are so many good things to take away from the 4% rule. One of the things that I really took away from is like the minimum suggested asset allocation is 50% in the stock market. And I think this kind of is counterintuitive to a lot of people in terms of what they think. A lot of people think, hey, the closer I get to retirement, I need to get more conservative. You've probably heard this rule of thumb, own your age in bonds. So if you're 60, let's say, that would say you need to own 60% of your portfolio in bonds and then only 40% in equities. Well, I just think that rule of thumb is outdated because people are living longer and you don't want to bring unnecessary inflation risk and longevity risk into the picture. But there are a lot of downsides to just following this 4% rule blindly. Okay, I think that first one to point out is just overall in terms of the investment allocation. That upper limit that Bill Bengen pointed out in his study, his suggested upper limit was actually upwards of 75%. He said, if you can actually target a 75% equity exposure, like you could potentially increase your rate of withdrawal. Now you'll have more volatility in the portfolio, no question. And does that sync well with your risk tolerance? And that's what you need to ask yourself is like, hey, yes, I could take more risk and increase my rate of withdrawal. But if we go through a dot-com bubble, if we go through a great recession, 08, 09, or whatever the next sell-off might be, the pandemic sell-off in 2020, whatever that might be, can you stomach that downturn, a 20 or 30% downturn? If the answer is no, you might want to get more defensive. You might want to get more conservative, not too conservative, though. I've talked about it in the podcast, don't get too conservative too early. But I think the first drawback with the 4% rule is just that simple asset allocation of 50% in the S&P 500 and 50% in U.S. Treasuries, because we do know modern portfolio theory. We do understand that adding additional asset classes, not just the S&P 500, not only reduces volatility and reduces risk, but also improves expected rate of returns over long periods of time. Now, of course, over the last decade, if you were 50% in the S&P 500, you're feeling pretty good right now. But going forward, what got you here may not necessarily get you there. So just think through your investment allocation is a big one. Another downside of the 4% rule is that it doesn't necessarily factor in the timing of other income sources like Social Security or pension. Okay. It just kind of assumes, hey, you're going to start with the 4% and then you're going to just do that forever. And this was actually one of the whiteboard fireside chats that blew up on YouTube, was just this idea of understanding your Roth conversion window. And oftentimes when someone retires, they may be delaying Social Security. They're not subject to required minimum distributions yet. Those typically will kick in at age 73 or age 75 when you're forced to make withdrawals from the portfolio per the IRS code for any tax-deferred vehicles. So maybe you're not subject to RMDs for another decade and you're not taking Social Security. Your taxable income might be next to nothing. This could be an opportunity to not only aggressively withdraw from your portfolio or withdraw more because you're not taking Social Security, but also to convert assets into Roth accounts versus tax-deferred accounts to minimize the impact of those RMDs when you do turn 73 or 75. And so the 4% rule doesn't really take into account the timing of other things. It's sort of like someone who retires at, let's say, 67, they start with a 4% rate of withdrawal because they're also taking Social Security already. But if you decide, hey, you know what's in my best interest? I want to delay Social Security until 70. So there may be a 3-year or 4-year or 5-year gap until you start Social Security. Maybe your rate of withdrawal starts at 6% or 7% or even 8% a year. The 4% rule doesn't characterize this necessarily. Okay, it doesn't take into consideration those future cash flows. And so this idea of the asset allocation and the timing of other cash flows, what this oftentimes leads people to do, existing retirees that are following this 4% rule guideline, or maybe their advisor told them to start with a 4% rule for whatever reason, because they just said, hey, you know what? This is what Bill Bengen said. This is gospel. Let's just follow that. ultimately that leads to this idea of underspending in retirement, which is exactly what I want my clients to avoid. In the early years of retirement, you're going to be in your go-go years. This is the window of time, hopefully, that you can take advantage of those bucket list travel or those epic golf trips that you've always wanted to take, whatever that might be. When you're healthy enough to do it, that's when you probably are going to be spending a little bit more money. And that's been my experience with clients is in that go-go years, they typically spend a little bit more. And then at some point in time, they start to slow it down. And then they enter the slow go years. And then later on in life, they go to the no-go years. Okay. And so the 4% rule assumes that same inflation rate every year. You're probably not going to be sustaining that forever anyway. So why not actually start with a higher rate of withdrawal on the front end and then back down those rates of withdrawal over those different spending phases. Okay. But again, Bill Bengen's research has been revolutionary. It's entirely changed the framework in terms of portfolio withdrawals and understanding what that safe withdrawal is. So I think a good exercise for all of you is to kind of think through, hey, what is my rate of withdrawal? Like, would my rate of withdrawal be if I retired today? Like, let's say you're a federal employee and you're like, hey, I've got $1 million in my TSP or whatever that is, and I've got a couple $100,000 in my brokerage account. How much do I need to replace my income? And then figure out from a percentage standpoint, what is my percent rate of withdrawal? And if it's, let's say it's 10%, I'd probably not retire at this point in time. If it's 6%, okay, 7%, okay, we can work with that because then we need to, ask the question about pension, the timing of Social Security, spending stages, your investment allocation, and all those can factor in what a safe rate of withdrawal is for you specifically. That's what you need to figure out is what is your safe rate of withdrawal. But what I loved about this study that came out a little later, okay, and I've talked about this on the podcast before, but this idea of guardrails, okay. So Jonathan Guyton and William Klinger, they came up with this framework of guardrails. So essentially what guardrails, it's hard because I don't want to get it's hard without a visual on the guardrails. So I might actually jump into a whiteboard fireside chat this week on this one. So make sure to check out the YouTube channel. I'm going to do a guardrail whiteboard fireside chat next week because it's hard to visually show you without an actual visual. So the guardrail is essentially what it does. It allows for flexible or dynamic rates of withdrawal. So instead of starting with this 4% and then never changing and just giving yourself an inflation raise every year, which is fine, what guardrails allows you to do is kind of says, hey, if you start with a higher rate of withdrawal, it's still okay. Okay, you're still fine if you start with a higher rate of withdrawal, but have some rules around when you would need or want to make a change. Okay, and so kind of in came this idea of the decision rules. Okay, and there are 4 primary decision rules, which we're going to get to in just a second. But what I love about this framework, it kind of allows people to sort of ease into retirement and say, okay, let's sort of not 100% let the market drive what we take from a portfolio, but let's kind of give us a little bit of flexibility. If the markets perform really, really well, how can we give us a raise over and above just the regular rate of inflation? Conversely, if you retire into a year like a 2022 or a 2008, 2009, what's the decision rule to back down your rate of withdrawal? And so that's why I love these decision rules. So they're the 4 that Guyton and Klinger came up with. We've got number 1 is the portfolio management rule. Number 2 is the inflation rule. Number 3 is the capital preservation rule. And then number 4 is the prosperity rule. So the portfolio management rule, essentially, this is absolutely one of the keys to implementing that disciplined, unemotional, repeatable process in terms of retirement income withdrawals. It's so key. And I see this oftentimes is missed. Like for DIY investors doing things themselves, like they're not necessarily doing this optimally. And I do believe they're losing value within their portfolio by not having an optimal portfolio management rule. But essentially, it sort of allows for the framework of what are you pulling your income from? Like, because, it's not like interest rates are 6%. Obviously, if you're 100% in a 10-year treasury, you're probably getting close to 4 or 4.5%. And if that's all you need, at least for the next couple of years, you're probably good. But then what happens when interest rates go down and now your interest rates, your bonds mature, and now you have to reinvest those 10-year bonds at whatever the interest rate is at that point in time? You're probably going to have a problem finding that same coupon that you found in 2024 or 2025. But sort of like gone are those days, like in the 80s when it was like interest rates were double digits. And like, hey, I'll just buy a CD and I have 10% or 12% interest rates. Like that's not the reality anymore. So you need a framework of like, okay, you're going to have some fixed income in the portfolio in retirement, but you're also going to have a healthy dose of equities to protect against inflation. Equities, real estate, those are the only asset classes that outpace inflation over time. Fixed income typically holds steady lockstep with inflation, historically speaking. So the portfolio management rule kind of gives this framework of like, okay, you start with trimming the overweight asset classes. So like in 2024, let's look at 2024 as an example. Large cap growth by far, looking back in the portfolio as we did the rebalancing in the beginning of 2025, every single portfolio in our client's book of business, every single portfolio was significantly overweight in big tech. So what we did is we took some of those gains off the table and we used that for income distributions for our clients in 2024. If a client was taking distributions out monthly, most of the months we were trimming down big tech, not abandoning it, but trimming it down because we have a set target that we want exposure to big tech. Additionally, then what it does, it says, okay, we've got the overweight asset classes, we'll trim those. Then it goes down to using some of the fixed income from the portfolio or cash from dividends, dividend payments from stocks that you own. So basically, cash that's just sweeping in the account. Okay. So cash that's just sweeping in the account from dividends, dividends from stocks, interest payments from bonds that you own, and uses that cash as cash flow for retirement. And then the last piece, if there was any other equities that are not underweight, okay, so like that are sort of on target or maybe just above target, potentially trimming those, or even using fixed income to trim some of the fixed income allocation as well. So it has this order of operation of like trimming the significantly overweight asset classes, using cash from fixed income or dividends, interest payments, et cetera, and then trimming some additional other asset classes if needed. Truthfully, a lot of 2024, we were able to generate a lot of the income from those first two pieces using the portfolio management rule. The second piece, the inflation rule, is pretty simple. It's just like the 4% rule. Each year you give yourself that inflation raise. Okay. Other than what we're going to talk about with rules number 3 and 4, which is going to be the prosperity rule as well as the capital preservation rule. So the inflation rule, if you were following the guardrail philosophy or even the 4% rule in 2024 into 2025, you gave yourself a 2.9% raise because that's what the CPI was. The consumer price index rose by 2.9% in 2024. So you would increase your rate of withdrawal by the rate of inflation if you need to. Truthfully, I had these conversations with a lot of my clients going into 2025. It's like, hey, we were taking out X last year and we can give you a little bit of a raise. 2.9% was inflation. Do you want a little bit of a raise? What's your need? And a lot of them are like, hey, Kevin, we're good. Actually, like cash flow is working pretty well. I think that's a sign that inflation is tempered a little bit because I remember 23 going into 2024 is kind of the opposite conversation. I was like, yeah, we actually need to aggressively withdraw from the portfolio because inflation was so aggressive from 2023 going into 2024. I think it's moderated a little bit in 2024, but as I've talked about in the past, these prices are sort of embedded, unless we see deflation, which nobody wants to see deflation. These prices are sort of embedded. But the good thing is for a lot of our clients that are taking Social Security, that automatically gets the CPI bump, at least some of their income is increasing with inflation via Social Security if they're taking Social Security. So yeah, truthfully, looking back, going into this year, there were only probably a few clients that we increased the payments for, and those were clients that were simply taking required minimum distributions, and their RMD goes up every year. Okay, so the RMDs, the way they're calculated, they use the IRS life expectancy tables. So each year you turn 1 year older, the life expectancy shortens, and therefore the percentage that you need to take out goes up just a little bit. Okay, so for those folks, yeah, they had a little bit of a raise. If I were to guess it was probably around like 5%. In terms of a raise last year. So a little bit higher than CPI, but it's also dependent not only on the life expectancy factor, but also on portfolio balances. So because portfolio balances increased in 2024, they experienced that raise via the RMD rule. Okay. All right, let's talk about this capital preservation rule. So this is a very important part of framework with Guardrail. So if you are going to start with a more aggressive rate of withdrawal, let's say 6% or 7% or even higher, okay? And again, I'm not recommending any percent rate of withdrawal. Every rate of withdrawal is going to be dependent on your unique situation, the investment strategy that you have, your life expectancy, timing of other cash flows. Okay, so the tax implication. That's another drawback of the Bill Bengen 4% rule. It didn't really take into consideration tax implications. So if you have a lot of money in tax-free accounts or taxable accounts, those are going to be more tax efficient from a rate of withdrawal standpoint than a tax-deferred account. So that matters as well. But the capital preservation rule, the CPR, it basically involves you having the framework of actually when you need to cut your withdrawal. Okay. So the general rule, the most popularized rule is that if your rate of withdrawal increases, not because you gave yourself a raise per se, but it's really because the portfolio balance went down. So if your portfolio rate of withdrawal increased by 20%, you cut your spending by 10%. So this creates this framework of like, okay, if things are bad in the markets, let's compare my rate of withdrawal this year. We just had, let's say we're in the beginning of 2023. S&P 500 was down 20+%. Bonds were down close to 15%. Not good for a retiree portfolio, 60-40 blend. So let's kind of put some numbers behind that. And this is why I want to do a whiteboard fireside chat next week so I can actually break it down on a whiteboard. But let's say you had a $1 million portfolio and your starting rate of withdrawal, let's say, was 5% or $50,000. Okay. So the capital preservation rule, it would say your rate of withdrawal needs to go up by 20%. Okay. So if you were taking $50,000 from $1 million portfolio, okay, so what would need to happen to your portfolio balance in order for you to be withdrawing 6% in this case? Okay. Because 20% of 5 is another 1%. So you would need to be taking 6% out of your portfolio. So let's say 50,000, 106, your portfolio would need to drop by about $167,000. It would need to be worth about $833,000. So $1 million, 170, put some 170 million. That's about a 17% drop. Even in 2020, that didn't necessarily happen. Okay, you probably had a drop of 13% or 14% if you're invested in a 60-40 portfolio, a disciplined 60-40 portfolio. You probably experienced a 13-14% drop. So even in 2022, you didn't experience the capital preservation rule. And like the study actually showed, and this is why I'm going to break down the study next week. The study actually showed that I think on average there was maybe like 2 or 3, depending on your asset allocation, like 2 or 3 times, historically speaking, that someone actually needed to make a cut. But the majority of the time, they could actually increase their spending by 10%. So this is on the flip side. This is what's called the prosperity rule, rule number 4. So the prosperity rule says if your rate of withdrawal goes down by 20%, so using that same example of $50,000 from $1 million portfolio, so now your rate of withdrawal needs to go down to 4%. Okay, so that's a 20% reduction. Okay, so if you were taking, let's use the 50,000, what needs to happen for you to only withdraw 4%? Your portfolio needs to go up from $1 million to 1.25. Okay, so this is the prosperity rule. So typically what happens, this is probably not going to happen overnight. Like if you have $1 million portfolio, all of a sudden you're not going to get prosperity rule after 1 year, unless you had a great year in the market, because that's about a 25% increase in terms of portfolio value. So what happens is this is sort of a gradual process. It's like each year you're maybe giving yourself a little bit of an inflation raise, but if you retire into a year or a period of time of prosperity, you could potentially reevaluate and give yourself an additional raise over and above the CPI. And again, the benchmark that Guyton and Klinger uses is a 10% increase in your spending. All right. What I love about the Guardrail framework, it sort of allows for, it kind of, number one, it protects against this uncertainty of like, okay, if you retire into bad times, what do you do? Can you save your portfolio? The answer is yes. And there is an actual framework that goes along these 4 decision rules. Okay. But on the flip side, it also protects against this risk. And in my opinion, this is a big risk for a lot of our clients, is this idea of underspending in retirement. And so, what Guyton and Klinger found was that if you follow these guardrail strategy, these decision rules, you could expect 7, even 10 raises in retirement of 10% or more. Again, depending on the type of market you retired into. In addition to that, you're going to be starting with a much higher rate of withdrawal. I mean, 4% is like a 4% starting rate of withdrawal is a very conservative rate of withdrawal, because again, this takes into account the worst case scenario. Someone retiring in 1966. If you happen to retire in a 1966 type of environment, that's just bad luck, but you're probably going to go through multiple portfolio capital preservation rules at that point in time with guardrails if you implement it. But for most of you, you could probably start with a higher percentage rate of withdrawal. Maybe it's 5% or 6% or even 7% or even 8% in the beginning, knowing that, hey, you have a process, a disciplined process to cut your spending if needed. You have a process to increase your spending if needed. You have a framework in terms of where am I pulling the income on an ongoing basis to generate retirement income. And that's the biggest thing. It's like, hey, what assets are you pulling from? That's the biggest change from an accumulator versus a decumulator is you're actually having to make portfolio management decisions, selling decisions. Okay. In addition to that, you can also think through the timing of other income sources like Social Security, like pension, or annuity income you have coming in. All right. So I think the takeaway that I would have for you if you're listening is number one, really dial in your cash flow. This sort of goes back to last week's episode is like really understanding your cash flow is going to be the key to everything, because then you kind of factor that in. Like, what are my needs? What are my wants? What are my wishes? Okay. And how much of my income need is going to be generated from Social Security or guaranteed income sources like a pension. Okay. And then what's the gap? How much of my portfolio in terms of income on an annual basis do I need to generate from my portfolio? And there is your starting rate of withdrawal. Okay. Once you have your starting rate of withdrawal, you need to decide, hey, am I going to invest to leave the most money I can to my heirs? Probably want to start closer to the 4% rule or even a 3% rule. Okay. If you're like, hey, I want to maximize spending in retirement, I want to maximize fulfillment, I'll even gift some to my kids along the way so I can actually see them enjoy their legacy, my financial legacy, as opposed to waiting until I'm dead and they're 60. Okay. So maybe you increase your rate of withdrawal. Maybe it's 5%, maybe it's 6%, maybe it's even 7 or 8%. Dave Ramsey got hammered on his show for suggesting a 9 or 10% rate of withdrawal for his listeners. I'm kind of like, hey, listen, I think that's a little aggressive, but if you have the Guardrail framework and have a process to cut your spending, and if you're invested properly and you're using the portfolio management rule and the prosperity rule and the capital preservation rule, it could potentially work. No one has a crystal ball. No one knows what kind of markets you're going to retire into. And so I think that's why it's so important to sort of like kind of marry those questions that I just mentioned with, hey, how is your investment strategy going to be implemented? What accounts are you going to tap into first? Is it going to be your taxable account first and then your tax deferred or tax free? Is it going to be a little bit of a different order? Because that's not always the best way to go. I mean, I think a lot of experts out there say taxable first, tax deferred, then tax free. And what happens is they just defer these RMDs and they run into what I call the RMD tax trap. I think that was actually the second episode I did in the podcast infancy, is talking about this the tax trap of RMDs. And I see this so much with like the older baby boomers that have been retired for 10 or 15 years. They are hitting this RMD tax trap like no tomorrow, because a lot of the advisors out there that work for big brokerage firms or wirehouses, and even the big firms that I worked for, we couldn't even talk about taxes. We couldn't talk about Roth conversions. And so this is a big advantage for a lot of you that are followers of the show and listen to other content, retirement planning content out there, and understand this framework of like, hey, let's figure out what your Roth conversion window is and let's minimize this tax trap of RMDs. But all of it kind of marries into this idea of rate of withdrawal and how much of a raise you should be giving yourself in retirement. Because a lot of you, if you're following the Guardrail framework, or if you're trying to figure out, hey, how much should I give yourself a raise? I mean, you could start with the rate of inflation, that 2.9%, okay, from last year. That's fine. But if you haven't necessarily given yourself a big raise in a while, maybe you've been retired for a few years, you're like, hey, what was my starting rate of withdrawal? What is it today? Should I be giving myself one of those prosperity rule raises? We've had a pretty nice run in 2023 and in 2024. So should I be giving myself a bigger raise, or what is a safer withdrawal rate for me? I mean, these are a lot of questions that our clients come to us with. And so listen, if you're retired or if you're planning to retire soon and you want to dial in your retirement income plan, we love to help our listeners out. I mean, truthfully, I was telling Roberto this. I want to make a mandate where we only bring clients on that are podcast listeners. Like, I'm not even messing around. I'm serious about this. And like, even if they found us in another medium, like let's say they found us on Google search or some sort of like third party, like a NAPFA or a fee only network, whatever it might be, I want to direct them to the podcast to understand like are some of our philosophies, because a lot of advisors out there think a little differently. They want to maximize the percent that you keep with them in their investment portfolio. It's like, because that's how they get compensated, And so, I think for us, we don't care in compensation for us. It's like, it is what it is. That's just a byproduct of doing good work for clients. And we're very blessed. Like, we have great clients that we're working with, but it's like, we love helping people. Like, we love seeing people that are entering this go-go phase of retirement. They're about to retire. And they're like, hey, how does all this work? Like, who can I trust on this one? You know what I mean? Because like, there's a lot of etchy individuals in our industry, unfortunately. And I saw a lot of those individuals, my first decade plus in the industry. And, we just take a lot of great pride in what we do. But we want our podcast listeners to sort of get to know us, understand our philosophies around spending, around these go year philosophies, spending rates, investment allocation, discipline, unemotional, repeatable process, tax optimization, okay, minimizing your lifetime tax bill. And so I'm not even kidding. Like, I'm going to create a mandate where even if you're not a podcast listener, I'm going to direct you to the podcast. Once you've listened to a few episodes, then you can reach back out to us and hire us. But if you're interested in that, if you're like, hey, love to get your feedback on what we're doing and ultimately what it would look like if we were to work together, just fill out that retirement readiness questionnaire. It's going to be linked in the show notes. Start there. We literally ask for no personal information. Like you can put your date of birth in, but like you can just put your first name, your email address, and then just some basic information about your financial situation and what you're trying to accomplish. And I'm going to follow up with a personalized Zoom recording, about some of my initial thoughts and sort of like, hey, if we were to tackle this together, where would we start and what would that look like? And hey, are we a good mutual fit? All right. And so yeah, if you're interested in that, just start with that RRQ, the Retirement Readiness Questionnaire. And we'd love to hear from you, all of you PFR Nation, and help you guys plan for retirement. Overwhelmingly, I think I mentioned this earlier, but the estate planning topic, the softer side of estate planning, I put this out on the YouTube. I said, hey, what are some of the topics that you guys want to hear about in the podcast going forward? And overwhelmingly, you all responded with the softer side of estate planning, the non-financial aspects of estate planning. So there's a very interesting article that Warren Buffett threw out there last year about reviewing your will with your adult children. And that kind of got the wheels turning with me. I'm like, ooh, this is a good one. Okay. So I'm going to kind of use that framework from that article, and I'm going to talk a little bit about estate planning and ultimately kind of talk about beyond the documents. Okay. Yeah. Great. You've got the documents, but what do you do with those documents? Okay. And how do you really protect your legacy? Because I think legacy is not necessarily just how much money you leave to the next generation, but like, how are you remembered? Are you leaving a big mess? Are you leaving things tightened up in order? So super excited about that one. And then we've got some other tax topics. I think Roberto is actually going to join an episode here in a couple of weeks. We're going to talk a little bit about tax prep and getting ready for tax preparation season. And one of the things that we just did for all of our clients is we created a little tax letter. So we said, hey, based on the financial situation, everything we know about you, here's a little checklist of tax documents we expect you to receive. It's just a little value add. We're not doing tax preparation at this point, but leveraging Roberto's experience on the tax side and doing tax prep, we just delivered those to our clients yesterday. And there's also some important deadlines, in terms of contribution limits and things of that nature that you really need to be thinking about before April 15th, before the tax filing deadline for most of you. So we're going to do another topic on that here in a couple of weeks. So yeah, that's it today, everybody. I hope you guys enjoyed this episode. If you found value in what we're doing, if you're liking the content, make sure to follow the show, of course, but make sure to leave that 5-star review. It really helps us reach more people, impact more people, which is what we love to do. So appreciate all of you, PFR Nation. Until next time, Kevin Lau signing off.